Okay, so I think that for this presentation, I was going to take sort of the perspective that not everybody knows much about blockchain. I know it's sort of a buzzword right now, but just to help me get a quick idea, who's heard of Bitcoin? If you've raised your hands. Okay, who's heard of like Ethereum? Okay, who's heard about like what Walmart is doing with their like supply chain projects with blockchain? Okay, anybody know what proof of work means? Okay, that's helpful. That helps me know like sort of where we are as an audience. So I'll spend a little bit more time like explaining what some of those things are so that we know what blockchain is, and then also talk in the second half of my presentation about like why that's important, why it's useful for things like flood insurance management. So I think that to begin with, I think the most like the biggest takeaway to get from this presentation is just understanding that blockchains are a tool to sort of shift the distribution of information in the networks that we're operating. So if you have a system, one more question, who's heard of like, you guys know BitTorrent or Napster or file sharing, peer-to-peer, those programs like that? So with a traditional like music software downloading service with iTunes or something like that, you have all the information stored on like one or a couple of servers that Apple runs. And then you have everybody connecting to that server in order to download the music or to download the movies and that sort of thing. With a BitTorrent or a Napster or those sorts of programs, instead of having everything on a centralized server, you have bits and pieces of those files residing on multiple servers, and everybody can sort of connect to other peers in that network, both to download the information from them and also to upload the bits and pieces of your movies or of your music to those other computers. So what Bitcoin and other blockchain systems do is they sort of take that model and they apply it to other things besides just like sharing music or sharing movies. So with a traditional financial processing system like you have Visa running, you have merchants and consumers all connecting to like a couple of servers that Visa runs, like maybe they'll have one in New York and another one in Atlanta. And those servers keep track of all the information on the Visa network, and people connect to those servers. They get the information about what your current balance is and whether you can charge $5 at Starbucks to your credit card account. And then Visa provides the information and says, okay, we've charged the $5. With Bitcoin, instead of having that information on a single server, you've got it on all of the nodes that are running on the Bitcoin network. So you have anybody able to write a transaction to the Bitcoin network and everybody being able to read that transaction as well. So if there's really just one thing to sort of take away with this, is that it's this shifting of the network models that we're looking at. So when we look at something like the National Flood Insurance Program, this is sort of a network topology for how people connect to FEMA and the NFIP. And so for like policy regulation, you have these NFIP communities, they're all connecting to FEMA and the NFIP. And like the primary insurance market, we have NFIP Direct and third-party insurers that are all helping to underwrite these policies and to administer them. And they're all providing this information back up to FEMA and the NFIP. And FEMA is acting sort of as that centralized point in the network, just like we saw with Visa or with iTunes. So what we're looking at in talking about how blockchain can help with these sort of flood insurance management issues is we're looking at shifting from this iTunes Visa model to a more distributed model. And what that looks like with this network is not only would you have like third-party insurers able to connect to FEMA and the NFIP, but you'd also have them able to connect more to each other and to share information with each other. And you can see that with systems like what Walmart is doing with their supply chain blockchain prototype right now. So what Walmart is doing is they're running this system for leafy greens like lettuce and kale and that sort of stuff, where they're tracking each of these products from the point where it's raised on a farm through each of the suppliers and able to track where that's going in the market. Not only can like Walmart track this information, but anybody else that's on their network can track this as well. So it incentivizes people to buy into the network, like Smith's or Kroger could also participate in this. So you have like sort of this wide scale deployment. And what it really helps to do is it shifts the benefits and costs from just being centralized to a single participant in the network. Like, I mean, Walmart's a huge company. It could technically, if they wanted to, force all of their suppliers to buy into this Walmart centralized database. But by shifting it to a more distributed network, you enable people to deploy their own pieces of that. So Kroger can develop their own infrastructure and reap the benefits from it. And similarly with like third-party insurers, like if you have a blockchain insurance management network, you're not only enabling those insurers to connect to FEMA and the NFIP, but to auditors and to banks and to each other. So if they're doing insurance issues that don't relate to FEMA and the NFIP at all, they're able to interact and to resolve their insurance management issues on that network as well. So it really can help to incentivize people to participate in the network. So that's one of the neat things about blockchain. It's also really one of the complicated things. And so once we've introduced that idea, I'm also going to talk, just to give you an understanding of where we're going, I'm going to talk a little bit about how you operate a network like that, because it's more complicated. You have to have some way of resolving the transactions that are getting added to the ledgers, and then also a couple of advantages that you get from operating using a blockchain versus using like some other centralized database in terms of embedded logic for smart contracts, and also for how different businesses can choose how much information they expose to the network. So to take a step back, this is an art meme that was going around the internet a couple months ago. Somebody's mom drew a picture of a swan, and it was kind of cute, and it got posted to Reddit. And then somebody else saw that and said, oh, I think I'm going to draw the person's mom who drew the swan and post that up there. And then somebody else did the same thing. And you can kind of see where this is going, is that you get more people drawing the person that drew the other person that drew the mom. But what happens when you have anybody able to participate in this sort of this meme, or to, if you think about it in another way, to submit these transactions to this network, is that you don't have a single way of deciding who should go next. And so you get a split where like most people were able to agree, like, okay, I'm going to draw this person who drew like at the third level, and then you get like this sort of network topology where there's this split from that person to a bunch of different people. This guy got a bunch of different people drawing what he drew as well, and you really don't have sort of a consensus about what's going on with the meme and who should go next. And so where this becomes an issue with things like blockchain and Bitcoin is that if you have anybody able to submit a transaction to Bitcoin, but you don't have a way of deciding like which transactions have actually been submitted, then you don't have a way of keeping track of what people's actual balances are. So you don't have like a functioning network. So in order to have Bitcoin work or to have other blockchain networks work, we need to figure out a way to have some sort of official record that people can depend on, but still not having like a single point of failure for that. Still not having just one person able to say like, okay, this is the transaction history. I've decided that these 20 or 30 transactions were the transactions that got reported today. Oh, and also, by the way, I can change the transaction history of any of the transactions that happened before because I have complete control of the network. So the way that we sort of do this is that we set up a couple of rules. One of them is going to be just that we're going to look for like the longest chain in this network, and you could think that for this metaphor as who's done the most like pictures embedded into their drawing, and the other rule, once we decide that we're going to do that, is we need to figure out a way to prevent people from creating arbitrary lengths of their transaction history. Because if somebody could create arbitrary lengths of transactions, then they could automatically create the longest chain in the network, and they could therefore, decide what the next network history becomes. So what I'm going to do is sort of shift that back towards like an understanding of how we do that with computers. And so I'm going to just take us to a really quick online demo. And this is neat. You'll get to see like what an actual blockchain looks like. So hopefully that's edifying and interesting for people as well. But this is what a blockchain looks like in a really simplified version. You have a number of these boxes where you can enter data. And what makes the chain about the blockchain is that you have each of these blocks recorded in sequence. And so and they all depend on the ones that have happened before. So I'll show you really quickly. With a traditional like single block, you can say, okay, Kerry pays Patrick $5. Oh no, terrible. Thank you for letting me know. Yeah, I have to exit presentation mode. Perfect. Okay, thank you guys. So in this sort of depiction of a block, you can have any sort of information entered into the data. I've said Kerry pays Patrick $5, so this is what I'm going to record to the blockchain. And if you'll notice, when I enter that data, this block starts out as sort of a green color, and then whenever I enter information into here, it changes the color of the block, and it's also changing this little string of characters and numbers down at the bottom. I don't know if you guys can see in the back there, but this string changes anytime you enter information in here. And this is based on some like cryptographic principles. It's really not that important that you guys understand this part of it. But the piece of this that is important to understand is that we want this string to match some certain characteristics. And so we click this button at the bottom here called mine, and that runs some algorithms. And I know I'm glossing over some of this stuff, so if you guys want a really more in-depth, mathy, nerdy explanation of this, feel free to talk to me afterwards. But we run some algorithms that take the computer some time to compute a new string. And it says, okay, this block is green now. This block is valid again. And so the piece of this to understand is that each of these blocks in this chain, you can see that the previous hash that's recorded here is the same as the hash of the chain of the block before it. So if I were to go into any one of these blocks, say the second block, and to say Kerry pays Patrick, then not only does it change the block that I entered that information into to a different hash, but it also, that information carries out through all the rest of the blocks in the chain. And so because I've changed this one block, that sort of change is detectable throughout the rest of the network. So we've accomplished two things in doing this, is by creating this mining criterion, we've slowed down people's ability to create arbitrary numbers of blocks and add them into the chain. And then we've also created a way to detect whether those changes have occurred and to be able to trace how they propagate throughout the network. So this does a great service for helping to secure the network. And part of why Bitcoin is worth so much, I know its value probably is fluctuating today as we're speaking a lot, but part of why it's worth so much is because it has a really long transaction history. So if anybody wanted to try and duplicate or replicate the Bitcoin network, they would have to go through this mining process for all of the blocks, all the transactions that have been recorded to Bitcoin in the past, almost decade of its operation. So that's helping to secure the network, to prevent people from being able to just throw computing power at the network and to be able to create arbitrary transactions. And it's also helping to prop up the value of Bitcoin. So just really quick, I want to pause here just to ask if there are any quick questions about this part of it before I move on to the rest of the explanation about how some of this stuff relates to flood insurance. Cool, yeah. That's,
being your name, Kerry.
yep.
And then block 2, you added Kerry pays Patrick. And
Sure.
so Kerry's the lead, and then every time you use the word Kerry in another block, then it adds to the chain.
So,
Is it a different piece of information that contains your name to each block?
that's a really good question. So the blocks in this data section right here, you can have any sort of information in there. So if I have Kerry in block 1, I don't have to have that in the same data piece in block 2. But what what keeps track of that information is this hash down here. And you can think of hash as sort of like a fingerprint. And we're saying that all of this data that I have in this data section, this hash that I generate is basically a fingerprint of that data. You run some algorithms, and any change to this data, like if I just add the number 1, it changes the fingerprint. So it compresses what the information is in that data block, and it allows you to, by altering this hash, you also alter the fingerprints of each other block in the chain. So it's a really good way of keeping track for that. So that help. Okay, great.
So to do this, did you go into some system for blockchain?
So for that demo, or,
In a real life scenario, is there a software that's for blockchain?
yeah, so there are a few different people that are developing their own blockchain systems. So IBM has one that's really popular with federal government applications right now called Hyperledger. The Bitcoin network is technically its own blockchain system. Same for a lot of the other cryptocurrency applications as well. Okay, so I'll forward back to this. Okay. I'm going to skip over this part. So we have a couple of this. Just to summarize, we have this concept of what a distributed ledger is. We have these algorithms that help us decide which transactions actually get recorded to the network, and we use some complicated math and cryptography to run those algorithms and to secure the transactions that are actually on the network. One additional piece that we need to sort of understand about blockchains before we understand how they're helpful for flood insurance is this idea about smart contracts. And that's basically just saying that instead of recording, arbitrary characters or whatever in those blocks, or just recording transactions of value like you do with the Bitcoin network, like trading 0.1 Bitcoin from one person to the next, with a lot of blockchains, you can actually record any sort of information in there, including like computer code. And so what that allows you to do is that instead of just trading or moving songs or movies from one participant in the network to another, you can actually execute code on the network as well. And so what that lets you do is to embed business logic in your network. So you can check if somebody's got like a certain balance in their account, and you say, okay, if Patrick has 5 Bitcoin, then automatically I'm going to bill him a Bitcoin on the 1st of every month. And so you can sort of embed these things in the network, and that gives you a little bit more flexibility than just recording arbitrary transaction data like you would on the Bitcoin network. The other important thing is that with IBM Hyperledger and a lot of these sort of permissioned blockchain networks, you have the ability to selectively share information with other participants in the network. So with Bitcoin, anybody can see all of the other transactions that have ever happened in Bitcoin. It's a completely public system. But with permissioned networks, it's sort of like a company's intranet versus like having a public-facing internet. You can selectively share like who has access to the network and how much information you're going to share with other people on that network as well. So to summarize, to talk about how this applies to flood insurance management and to other use cases, it's good to see with the algorithms that we have supporting the security of the network and providing anybody in the network the ability to see the transactions that have occurred, you get some of these benefits that are listed across the top about like transparency, security, auditability, and allowing broader network participation. So that can be useful for a number of use cases. Besides insurance management, I've listed some of these ones here and just sort of checked off some boxes about like which properties of a blockchain network make these sort of use cases exciting, or like why people are looking into blockchain for these sorts of things. For flood insurance management, we have a similar sort of setup where these properties of a blockchain network are going to help with these, like, I'd say like 6-ish things that you need to do with flood insurance management. And just to go over them really quickly on this slide, and I'm going to talk about them in more depth in the next couple of slides. You can get reduced compliance and monitoring costs. You have real-time policy updates. You have increased liquidity of reinsurance markets. You have some identity management applications and claims processing applications. And then also just being able to more transparently view the risks of the people that are participating in the network and how that might affect things like underwriting and pricing for your insurance management.
So, can I come to this for a second?
Yeah.
So I can see where if you have a standard policy and you update it, then everybody in the blockchain gets it all at one time, right?
Yes.
The efficiency of that.
Mhm.
But explain one of these other ones, how it would work.
Okay. Yeah. Yeah. Absolutely. And I might just go on to the next slide to do that. But yeah. Thank you. So one of the things that I mentioned with these permission networks is information selectivity. A lot of the things that you would get out of doing a blockchain deployment are similar to the benefits that you'd get from doing like sort of centralized data sharing. Like if FEMA required all of their policyholders to submit all of their information on a real-time basis and required all of their underwriters to constantly upload their information and to invest or to buy into this new infrastructure that FEMA is developing, they could probably get away with it. But for different stakeholders, there are reasons why you would want to be able to selectively expose what information is in the network. And with a centralized model, you don't really have that same ability. Like if FEMA or Walmart controls this network, they have the ability to see all of the information that's inside of it. And so for policyholder data, what you get out of that is being able to view people's data specific to an insurance policyholder without necessarily exposing PII. And so that can be really helpful for aggregating policyholder data or transferring that data between different underwriters and insurers so that they can understand what's going on with these particular risks and maybe which policyholders pose particular risks and are worth increasing the prices of their policies for without running across like any tricky issues of like data privacy, of knowing like too much, being able to drill down too deeply into the policyholder's particular information. And that's also true of like doing KYC and AML automation or compliance, so know your customer and anti-money laundering laws. Right now, a lot of that stuff is being conducted by each person that has a particular customer. So like if a bank or an insurance agency has KYC and AML obligations, each one of them has to run that process for every customer that they bring onto their network. Whereas if they were part of a shared network, you could really just have a single or a couple people that are running this KYC and AML compliance tasks, and then everybody else on that network can see, okay, maybe this customer has like a KYC AML certificate. So we know that they're KYC AML verified, but we don't necessarily know like their social security number, their bank information, and that sort of stuff. So that's part of the advantage that you get through doing blockchains versus some more centralized database administration. For policyholders, it also lets people transfer their policies between different insurers if they just want to find a better rate. They don't have to go through the entire process of like submitting all their information again, and they could transfer that a lot more easily. For insurers, I'm going to talk about the transaction data a little bit more on the next slide. But for what you get with operational data too is that if you have the insurers that are able to supply access to their databases and to their data to like FEMA and to regulators and to auditors, you can just provide like a direct key to the data that's on your servers, and you don't have to worry about, FEMA or your competitors or the auditors being able to see like, proprietary information that you don't want them to see, or competitive information. So it helps to facilitate the ability for people to just share the information that they want to share without sharing too much. And that lets you do things like real-time monitoring and real-time updates as well. So the other piece of this that's important about blockchains versus like centralized databases is that you can do that sort of smart contracts, embedded business logic. And that's helpful for things like policy updates and policy requirement pushes. So not only can people just pull the data like from insurers and policyholders, but if you give them permission like to FEMA and the NFIP, you could allow them to just update your policy requirements automatically. Like once they know what the new policy requirements by law or whatever are, they can just push those updates to the NFIP community, to insurers, to underwriters, and that sort of thing. So it really helps facilitate this real-time update and automation. And for different stakeholders, like for various insurers and underwriters operating together, a lot of times what happens is you'll settle the payments from a claim for policyholder A, and then do it again for policyholder B and policyholder C. And so sometimes, one insurer might pay another insurer $10,000 for a certain policyholder, and then the same insurer has to pay the first insurer $5,000 for the second policyholder. And so what you get is a lot of transactions processing where really you could just like aggregate those transactions if you knew like what the sum was. Like instead of saying like, I pay you 10,000, you pay me 5,000, I'm just going to pay you 5,000 instead. So by allowing the contracts, the smart contracts and the transactions to be able to include like some computer code in them, you're able to do things like adding up all the totals for the transactions, and so you're able to increase the efficiency that you're processing those transactions as well. And inter-party business process automation, that's sort of a catch-all or an umbrella for all these sorts of automation things that you might have different stakeholders wanting to do, but not necessarily having access to each other's systems currently in the way that lets them do it. So what that helps to do is just decrease costs and increase timeliness of information processing between different stakeholders. I'm going to talk really quickly about how all of this sort of can tie together for a use case for reinsurance markets. Reinsurance right now is a really, they require really complex contracts, and that generally the settlement periods can sometimes take months and a lot of time and effort and costs in order to settle, to be able to say, okay, we've decided that the conditions for the reinsurance payout have been met, and we're going to pay, FEMA, for example, $100 million because the floods that were happening in a certain area were just way more than they were expected. And because we could have the sort of like embedded business logic and data aggregation capabilities that you get from a blockchain network, instead of just having people going out and checking that all the conditions for the reinsurance payout have been met and then having to communicate that information back and forth, you can have a sort of program written from from the blockchain scripts that says like, okay, if this sensor data has met this certain threshold, and if these other conditions on the network are met, then we're just going to trigger an automatic payout. So you can reduce payout for some of these settlement policies from taking months at a time to taking hours or even minutes potentially once the data is entered into the network. And so that's a really tricky piece too, is how do you get that data onto the network? But once it's on the network, then you can really more efficiently process these sorts of things. And so I know a lot of the stuff is fairly new to talk about, but so I just wanted to open it up to you guys to questions as well.